All right. Well, I don't know if we're gonna get anyone else or not, but they pop in. They pop in at this point. We'll just start with what we have here and move and groove, I guess. So this week we're gonna discuss two important factors towards building a trade plan, working with a trade plan, and ultimately how to kind of work incrementally towards that process. So we're really talking about fundamentals this week more than anything else. We're not going to be talking about anything super advanced or something that you probably haven't already heard of, but we're going to go through my thought process towards things like categorization, and how to kind of break down each piece of the plan as we move through it. So specifically, we'll be talking about the strategic edge, which is what we typically do inherently when we're finding um, a way to trade. Usually, years 1 through 5 spend a considerable amount of time looking for the strategic edge, coming up with something, and then running with it without knowing if you have a statistical edge. So we're all very good at finding indicators that we think may help in certain periods of the market. So we're just going to go over um, a little bit about how most of that will uh, play into the next piece, which is the statistical edge, which is going to tell us things like, we have a 60% win rate with this core strategy, okay? Or um, we have some sort of edge that we can rely on even in the worst of times, right? When our emotions are overtaking us, etc. So, I want to talk first a little bit out of order here. I'm going to discuss number two here, the categorization of a strategic edge, basically, of a system. Okay. So, there's three main styles of trading that we've basically, or that I've basically come to find in 5+ years of trading now. And the three are basically reversals, continuation, and momentum. Now, what we end up doing when we build a strategic edge a lot of times is we start mixing different aspects of each of those into the plan, right? Into your trading plan. And we try and trade it as like a half reversal, half continuation, or half continuation, half momentum type of strategy. So, what we really want to do when we build a system as a whole is we want to identify which of those three systems we want to stick with. For instance, I'm a reversal style trader, so all of my trading styles are going to revolve around finding the edge of price, right? I want to know, when is that pivot likely to occur, right? I don't care about the breakout. I care about where the reversal is. Okay. What's likely to hold us up in certain areas? Where is there exhaustion? Where are there things like that? Okay. um, Continuation traders are those of you that want to get in on pullbacks, right? You want to see price move X amount or break a range or whatever, pull back to that range top, for instance, right? And then you want to grab the pullback for the long. Okay. Uh, and then the momentum traders are typically those that are going to be your breakout traders. They're going to be the ones that see price going up really aggressively or down really aggressively, and they're just trying to jump on the train. Now, each of them has their own sets of drawbacks, and defined risk parameters at the time. I would say that if you're typically trading reversal or continuation, you're going to have a much longer term of success than you are if you're trading momentum. Momentum trading tends to be one of the harder methodologies in the market because you can't define your stop as well. Your stop is likely to get hit even on the same bar. And especially if you're trading something like the NQ or gold or crude or something along those lines. If you're trading ES, you might be a little more safe, but it's still not a recommended tactic, uh, especially if you're trying to find a strategic edge. Yeah. So those are the three main categorizations that you should think about when you're dealing with your strategies. Is really reversal, continuation, momentum. Which style do you want to fit? Now, that kind of takes me into the indicators and the measurements of what we're talking about. So, what would make, for instance, I think continuation is probably the easiest to talk about when it comes to indicators because we're so used to a lot of them. So, a lot of the continuation indicators, right, tend to be things like the RSI, the MACD, so your oscillators, your cycles, your market strengths, a lot of that stuff plays into continuation the easiest, right? Because what we end up looking for, right, are um, very specific numbers on those indicators, right? So, for instance, let's just take the RSI on the chart here, and every time we see kind of an up thrust or new trend start, right? And actually, I'm going to take this down to a 1 minute. Every time we see a trend start, right, we typically are going to get into the RSI's oversold area, right? So this is where the idea of continuation and momentum kind of start kicking in for oscillators. And when we start to see a trend form, right? Continuation traders are typically looking for where is this going to pull back to, right, before it continues. And a lot of times they'll see things like this, right, where it's like, oh, okay, so it has to pull back to the 50, right, before the continuation continues, right, before the price continues down. Okay. The problem with this is that you're building a strategic edge at that point, right? Based on information in one little category of one little area on, in this case, the NQ, right? So we had a trend start, right? We had this downtrend. Oh, come on. We had this downtrend start, right? The pullback each time that it pulled back, right, across that level, we ended up coming back up above the 50, right? So while this may be true at times, most of the time we're not going to see benefits in the long term market, and definitely not on the other side, right? The long side. Um, we won't be seeing like the same type of measurement. Now, the the momentum traders are going to be looking at this as okay, when we get below the oversold portion, right? We want to start looking to get short as well, right? And once we get below that 30 level, we want to get short and we want to stay short, right? And where do their stops go, right? Sometimes, you're told the position size so that you put your stop over the top of the range that was just formed. Sometimes it's only a candle, right? And then you trail the candle down. In this case, it would have worked beautifully, but a majority of the days that are not, 2%, 3% down like we've been having, are just going to blow you out. Yeah. So in turn, I want to talk a little bit about each of the indicators and what they measure. Okay. And in order to do that, we got to classify once again a lot of what the indicators are, what they measure, what they do, etc. Yeah. In this case, the main category that we'll start with is really the momentum set, right? The momentum set of indicators here. And we're going to be talking a little bit about the CCI, but mostly I think about the MACD because it makes the most sense to most traders. Now, it doesn't matter whether you're a momentum trader or a continuation trader. When you build your strategy, you're almost always going to have some form of oscillator. You're almost always going to have some form of volatility, and you're almost always going to have some form of either moving average or momentum style indicator. Otherwise, you can't really build your process for your edge. And we'll get into the actual process creation after we get through all of these indicator pieces. But um, the MACD, I think, is the most simplistic for everybody to kind of understand and get. It's one of the first indicators you ever see that they ever shill. And simply simply put, it's not a bad indicator to throw into any process. It does have quite the statistical edge already, I can tell you. It's probably the only one on this entire list that I can say with 100% certainty holds its weight compared to everything else around it. Um, and you get really good results even when you double the values of it, right? For longer term plays. So there's a lot of merit to it. But when we start talking about what does it really measure, right? Are we measuring the speed of the price action? Are we measuring the pullbacks? Are we measuring, is it giving us reversal signals, right? Is it giving us continuation signals? Um, we're really measuring off the MACD. We're really taking two moving averages, right? And applying a constant number to the calculation, right? That's outputting two separate lines and a histogram that are telling us, right, what price is doing, you know, within a relative margin of error. Okay. This allows us to classify this into the continuation slash momentum area better. I think for continuation traders, this thing ends up being your bread and butter. Okay. Because we really want to measure when price is likely to turn in a trend versus on a reversal or anywhere else. So when you start building your strategic edge, if you're a continuation trader, you would want to start seeing things where the lines cross and you got pivots, right? That's ideally what you're looking for. How do you line those up, right? Which way is price going? Where's your MACD? And where's the cross likely to happen, right? To get you a good entry into into the trend, basically. Oscillators, we'll just move on to the next session. Oscillators are going to tell you one of two things, either reversal or trend continuation. Oscillators are typically ill talked about in continuation trading, but are talked about quite a bit when you start building a system based around reversals or momentum. And that is because of the same reason that you guys have all heard before. I'm sorry, you guys will hear my kid talking in the back, but um, what you guys will mostly hear from years 1 to 5 about um, stuff like the stochastic or the awesome oscillator or the RSI or any type of oscillator, right? Is that you'll have overbought oversold levels, and the overbought oversold levels are uh, an easy way to shill out false information. Okay, because what oscillators end up measuring, right, can be both momentum and reversal at different times and do require a cool off period for most. So if we take a look at the RSI again here, we actually have, when it goes sideways, a small cool off period, right? Where price and the RSI will float through the middle of the overbought, oversold, and will give us different types of signals based on uh, where it's at in the reset process before it picks a new direction. So a lot of times you won't be able to utilize an oscillator for continuation as well. And if you're a momentum trader, I think that oscillators are probably your bread and butter in that case. So moving into kind of volatility, um, we really only have a few ways to measure volatility effectively. And obviously, I think everybody in here knows about the ATR and the Bollinger Bands. I won't get into the ATR too much. There's much more qualified people to talk about it than me. But I will say, for any type of process that you build, volatility needs to be a consideration because the market will react differently based on volatility a lot of times. So if you build your zones based on volatility, whatever that means, right? Or if you build your zones based on an oscillator, you'll typically be able to capture um, the volatility in those snapshots, right? And for those of you that may not have seen my wave trend originally, you can basically build zones off of oscillators when they reach their peaks, right? Or their valleys and they cross. If you mark those candles up, you'll actually start to see some very interesting things through the market. Um, Not dissimilar to what Magnum does with the BB poke boxes. Okay, so um, volatility. Oh, there we go. Again, volatility is an important factor that should always be taken into account. It doesn't necessarily need to go into your trade plan if you don't want to, but you will get into different types of trouble if you don't consider it as the volatility decreases going into summertime. So I just want to call that out right now. You will start to see issues with your strategy if you have a highly volatile strategy that requires a lot of volatility. Something that's often not talked about is cycles. There's only a few ways to measure cycles. There's not a lot. One of them being the TTM wave, and all it really refers to is that you have distinct uh, waves that are usually set to some form of EMA, SMA over different periods, right? And they oscillate. Okay, that's what cycles are typically represented as. What they try and measure is both the long term and the long term, the medium term, and the short term, right? So if you think about it from like a 9 EMA all the way up to a 200 EMA, it tries to take all of that information, condense it into one indicator, and then give you an output based on the cycles. So what you're really measuring is ends up being kind of market strength as well. Uh, which, in terms of market strength, which is our next category, we have things like the accumulation distribution line, which Dama likes to use. We have the money flow index. We have the Chaikin oscillator. We have things that try and attempt to measure how much interest there is or how much volume is going into the market at any one time. Sometimes they're useful indicators. Sometimes you can build a process around them. Uh, as far as categorizing them into any one of the reversal, continuation, or momentum, you can really put them on anything, and they may or may not help you. When you build your strategic edge in your process, you're typically going to have to at least take a look at one or the other and see if you can find anything that mechanically makes sense for you to look at. And then, of course, the other major pieces are moving averages. These are the first things that you're really taught in trading in general. So I won't go into too much of them, but SMA, EMA, WMA, right? What are they measuring? They're simply measuring the trend. You can use linear regressions, you can use channels, you can use, pretty much a million different things to identify a trend, though. And then the last one is zoning, right? Uh, I left this for last on this portion of the fundamentals and the indicators because I really wanted to kind of tell you that if you're not building zones, if you're not finding a way to build those zones in, you're really at a disadvantage no matter whether you're a momentum continuation or reversal style trader. You really need zones. Um, it doesn't matter how you build them, but you really need to find an area on the chart that says there's a high likelihood for price to continue here. There's a high likelihood for price to reverse or pull back to. You need something to help support your idea, some form of structure to support your ideas of where the market's going to go. It doesn't have to be all the way up on a daily, it doesn't have to be an hourly chart. It can be a 5 minute, it can be a 1 minute, it can be whatever. Just find some way to make a zone, and bake it into your overall process. So let's discuss what the process is, um, how to build one. I'm sure most of you obviously understand how to build a strategy of some sort, but building a strategy, executing on it, typically requires more than just being able to say like, "Hey, I see this, 5, 10 times on a chart. I'm going to stick with this and see how it works over X amount of days." Right? You typically need to select yourself a core set of indicators that you want to work with. So, for instance, for me, my core set is Bollinger Bands and the volume flow. Um, Basically, what I attempt to do with these indicators is capture volatility, kind of the edge cases, right? And then I also want to capture um, the important volume areas as well. And if I can do that, I feel that I have a strategic edge, right? Where I can zone something, right, effectively and potentially buy the reversal the next time that it reaches that area, right? So, for instance, just to kind of go into the process just a little bit without taking too much time, is I'm going to look at these edge cases like this up here, right, where the last Bollinger Band poke on a major green candle, right, which might have had a set of trapped buyers in the last leg up, right, followed by sellers coming in at the top, right. I'm going to box up the sellers, right, because I think the sellers are going to hold that level, right. So ideally, what I would like to see is that when we fall away from this area, the next time we revisit it, right, it's going to fall away from it, right? It's going to tap that area and it's going to fall very drastically, in which you can see it does over here, right? That's that's the hope for me as a reversal trader, right? And that is the core set of my current strategy now, right? So when we build these, it doesn't have to be um, super complex to start with, but the process I use to find the trade entry right? So my execution would be, for instance, right across here, right? That's not really clear. My trade execution would actually end up being over here, right? And my risk is defined as to the back of uh the two yellow lines here that I drew on the chart. The process in order to get there was I had to find a BB poke, I had to find, sellers at the top, potential traps in the long bias, right? And then I can start to come up with kind of the process before the execution. And it's important to separate the two, right? Your entry, your take profit, all of that, think of it as a separate strategy altogether, or a separate process. Okay. Your main process should take your core indicators and whatever auxiliary indicators you want, right? So, like, I could add on stochastics or RSI or the TTM squeeze or CCI or an SMA or an EMA, whatever, right? And try and use it as extra confluence for me to get in long or short off of this level, right? But the important thing is that I zoned, I captured the volatility, right? And I captured the volume, right? Um where the traps were, basically. So all of this to say is that grab yourself a core set of indicators to work with, right? Build something that you can say on the chart that, yes, this looks like it works quite a bit. It works well, right? Add in auxiliary pieces without changing your core set whatsoever. Add in those auxiliary pieces until you come to a full process that you can say, yes, this seems to work. Okay. That's your only goal when you're trying to build the trading plan. Okay. Then we can kind of move into uh, the statistical edge, right? Now, there's plenty more people, more educated, and more uh, probably better at telling you about the statistical edge. For instance, you guys can always talk to T Gain for additional information too. I'm sure he can answer uh, questions on various things like that. You can probably talk to Magnum whenever he's around as well about it. Those guys have tons and tons and tons of years of experience on specifically stuff like the statistical edge. Okay. Now, the statistical edge alludes to the fact that we have a process, we have a strategy now, but what is the actual outcome, right? Over 100 trades, over 400 trades, over 1,000 trades, right? We discuss it a lot in the mornings, um, every so often in the room here. And really, if you can't say that, hey, my strategy gives about 68%, gives about 70% winners at 2 to 1 R, then you really don't have an idea of what your statistical edge is. And that's where things like T gain spreadsheets come in handy, right? Or a journal comes in handy, right? So that you can go back over 100 trades, right? And let's just say we throw on 30 days here of data. This is to say where we do the same process that we identified already, right? And we move all the way to the left, right? And we start charting over here, right? Get as close in as we can. We start our charting process and we start adding things to a spreadsheet to say, was this trade a winner or a loser? Okay. And to show you kind of some of that, right? Take a look at what that is. So the last set of data I did here, right? I found out very quickly that what I was doing made no sense whatsoever. Shouldn't have been trading it. Don't know how it worked for quite some time. But I found that data really, really fast. So all the trading journals need to have to really identify this is, what was the position, long or short? What was your entry price? What was your stop loss price? And what was your exit? For this particular one, I put on a 3 to 1. I wanted to know, does 3 to 1 hit? Right. And we'll kind of get into the RR here in a little bit. But um, you really just need to know win loss percentage and kind of what if any comments, right, was different from that setup compared to like your normal setup, right? And you only want to do kind of your A plus setups, like identify your process, find the most ideal setup that you possibly can, right? And that is the setup that you want to put into this trading journal. That's what you want to identify. Every single trade should be close to an A plus, right? And then you're trading that A plus, throwing it into the spreadsheet, and then you're coming out with a win loss scenario, right? And a win rate. I ideally like also to write down my rules beforehand as well. But I think it's important to kind of call out the rules for that particular data set. That way when you look back over it, you know kind of what you're talking about, right? So you don't have to be perfect at this process. Um but to catalog kind of what you should be looking for, what you're putting into your strategy, and then what that statistical edge is, right? You learn quite a bit about your strategy, what type of trader you are, and what you like to see out of the market. So if you're not trading the spreadsheet, if you're not writing down your entries, right, and you're having trouble with consistency, this is how you break that consistency problem, right? This process right here is probably the single most important thing that we can do for our strategic edge that we identified in the previous portion of this talk, right? This is how we take that strategic edge, apply it to paper, and let the data tell us whether or not we have a winning strategy, and then pivot based off of that. Now, let's just say that you run into a situation like what I had with the 35%, right? I did not take and do this data set and then say, okay, I need to throw away everything and start from scratch. What I did was I took my core process, right, which is the Bollinger Bands and the volume, right, and I scaled back. I said, okay, the auxiliary that I added on to this, right, or the rule structure that I added on to this did not work, right? Holistically, as a set, it just wasn't a good strategy. So now I'm going to take my core set, right? And I'm going to find new strategic edge, a new process to build with, either new indicators or a new setup of some sort, right? Where I know exactly what those indicators measure. Okay. And I'm going to go back through the process and start combining things again. Okay. And then I'm going to come back to the spreadsheet when I'm ready, right? And I'm going to make a new sheet. Like you see, I have a couple sheets down here. I'm going to make a new sheet and I'm going to go through a new set of rules and a new set of data and figure out what that looks like. Yeah. Now, kind of uh, part of these talks kind of break down a little bit more with talking about the risk to reward ratios, right? So, if you've ever discussed risk and reward with any of us in here, we typically talk about 1 to 1, 2 to 1 the most, I think. Unless we're talking with Magnum, in which case it's 2,000 to 1. Um, but typically speaking, most traders are going to stay within that 1 to 1, 2 to 1 ratio. Um, Now, I want you guys to understand kind of where the break even points are for a 1-to-1 ratio. The break even point for a 1-to-1 ratio is not 50%. Your break even portion is actually back about 5%. It's about 45% at 1-to-1. Okay. And there's a lot of factors that make that true across the board. Um, for instance, the last set of data that I did at 1-to-1, one of the big things that came up is that realistically on a 1-to-1 ratio, every time I'm getting a winner, right? If I have multiple contracts, and this really goes to talk about multiple contracts versus a single contract. If we're talking single contracts, we're not really this talk really won't apply. But most of us here are going to trade multiple micros, right? Some of us are trading multiple minis, right? So this conversation really does apply to anybody who's trading more than two contracts, basically. So I want to take a set of 5 contracts, right? And I want to go long. Okay, at 1-to-1, right? If I were to take all 5 contracts off, then it makes sense for me to get X amount of data out of it, right? Leaves no room for any runners, whatever. But when we start doing things like I'm going to take 4 off and leave a runner, right? Which is a common way that we're taught to do it, that a lot of us like to do it, right? Leave some on the table, go for a farther target, etc., so that we don't miss a majority of the move. If we move 20 points, right? Take off 4 contracts and come all the way back on that last contract, we've actually made 0.8 to 1 on our risk to reward, right? Do that over the course of 5 more trades, and you've just lost an entire trade on that one contract going to break even. Okay. Now, this could be a significant problem, right? When you're dealing with the risk to reward ratios, especially at 1-to-1, because you may not even feel that loss or that string of losses that do end up occurring until you actually start taking the losses, right? Until you start taking a full, you know, 5 contract loss on that. Okay? So it's important to note that you definitely want to cover. You definitely want to try and stay above the 1-to-1 ratio if you can, and try and stick to your 2-to-1 ratios uh, for your risk size, basically. So I try and stay at about 1.5. That way, no matter what happens, that last contract comes back, I'm still over 1-to-1. And the reason that I say that is because you typically, when you build these strategies and you have a winning day, right? You're typically about 20% over your break even point when you look back through your data, right? So if you're an 80% trader, your break even point's probably about 55, 60%, right? If you're a 60% trader, your break even point's probably about 40% win rate, right? So it's important to keep track of where your break even point is and what that win rate is, so that you know that when you look back through your trades and whatnot, you can say, okay, I traded at 30% this day and I lost X amount of money. I traded at 45% this other day and I lost significantly more money. What the hell happened, right? You can adjust for your RRs. You can make small little changes in the RR to actually affect your overall P&L, and potentially turn losing days into winning days, um, and vice versa if you're not careful. Um, Now, what you'll hear in here a lot of times if you're doing a spreadsheet is that each one of these sheets here ends up being a new loop, is what we end up calling it in here. Every time you come up with a new strategic edge, you should go through a loop to identify what your win rate is. No matter what, put in the work, try and get down 100 trades. Try and at least get down 20 trades, actually. Not even 100. Try and get down 20 trades in the spreadsheet and figure out if it's worth continuing, right? Figure out if you got exactly what you thought you were getting out of it. And if you were getting what you thought out of it, great. Go to 100 trades. My first 100 trade set of data was very insightful. This thing right here was super insightful. I was able to gather a lot of information about the wave trend levels that I was making. I was able to understand more conceptually about the way that price was moving in relation to my core set of indicators. It will give you a deeper understanding of the market and the holistics of your own setup. So I highly, 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 highly suggest going through backup loops or statistical edge loops every single time you change a piece of your indicators. Okay. I know we talk about back testing and forward testing as well, right? Forward testing can be done after your back test loops are shown to be consistent. And I think it's important to note that um, your back test loops need to come first. You should not be forward testing first. You need to do your back test loops first and identify what was there historically, and then move forward uh, with the forward testing at that point. Once you got like a solid base down that kind of covers exactly what you want to measure in your process, because ultimately that's what we're doing when we build a process in the first place, is that we're trying to measure the market to scrape some money away from the big guys, right? That's what this comes down to. We're all scientists in here trying to fucking scrape a little bit of off the top, right? Trying to figure out exactly what makes the market tick so that we can scrape off a little bit off the top. Mm. And then the last major topic here that I have that I really wanted to discuss was um, try and make not very large changes in your daily routines. Don't make large changes in your trading plans. Don't make large changes in general. Don't take, for instance, your entire core process, throw it out the window, come back and pick up an entirely new core. Uh, make incremental changes on your core process in your daily life. No matter what you do, always work on things in increments, right? It's the idea of having a ladder, right? Do you want to climb a ladder with a lot of space, or do you want to climb a ladder that has, a lot of little steps? Which one's safer, right? Try and take the approach every day, right? When you're working on your trading plans, or when you're working on, for instance, those of us that code, when you're working on your code, just make small incremental changes at a time, one problem at a time, right? Um, I think those of us that program already break down a lot of problems into sub pieces and then solve for those problems. So we have an initial bias to increment daily. Um, but for those of you that don't, it's just super important to try and sit down and work on one thing at least on the day. That's a small change, right? One small pivot. Other than that, that's really all I have for the day. I don't really have too much else. Yeah, so if you guys have any questions, let me know. Other than that, I will conclude today. Thanks for showing up, guys. Thanks for hanging out. Thanks for listening to me ramble for almost an hour. Much, much, much appreciated.